everyone, welcome to my channel, The Media. I'm Andrew. In this channel, we'll be looking at disruptive companies. And if this is your first time, welcome to my channel. And if you are a returning subscriber, thank you for your support. And remember that I am not a financial advisor. Everything I say in this video is my opinion and is for educational purposes only. Hello everyone. So I've been seeing a lot of negative comments due to fear and people selling off, causing massive red days in the stock market recently, and it has to do with the fact that the Feds have been meeting to have a discussions, and today is their final day of that discussion. And as I've mentioned before in the last month's video, that until the interest rate changes, until the Fed decides to jack it up, then we shouldn't have anything to fear. And so today I'm going to read to you an article that explains what's going on from CNBC on the Federal Reserve. It's entitled, "The Fed Must Walk a Fine Line Wednesday as Financial Markets Hang in the Balance." So the key point, the Federal Reserve concludes its two-day policy meeting Wednesday with expectations for no change in interest rate. Okay, that is important. It's not going to be something that you need to freak out yet. Number two, however, Bank of America said the meeting will be one of the most critical events for the Feds in some time. Number three, Chairman Jerome Powell and his fellow policymakers will have to convince investors that the current policy is correct and won't change in response to a brighter economic outlook and major changes in the COVID-19 flight. So I'm not going to be reading to you the entire article, but I'm just going to be pulling out quotations that I think it's important. The challenge for the central bank this week will be to explain the position to investors and reassure them that even if the status quo remains, that won't provoke policymakers to change course, nor should they. The basic line is everything looks a little better, but there's still a lot of uncertainty. We're not going to do anything soon. They don't want to suggest that things are better, he said. On the other hand, they don't want to suggest that they're going to change policy anytime soon. So it's a tricky communication. No one is expecting broad stroke changes. Short-term borrowing rates will remain near zero, and the Fed will continue buying at least $120 billion a month in bonds to keep market flowing and financial conditions loose. So for the individual members, they will update their forecast for gross domestic product and unemployment and inflation. All of these are triggers for the stock markets. Domestic product, unemployment, and inflation. So for that reason, that's why their meetings are important for us investors. Here, they last submitted estimates in December before Congress approved two stimulus packages totaling near $3 trillion and before a COVID-19 vaccine rollout that is seeing 2.4 Americans inoculated every day. Goldman Sachs recently raised its GDP forecast to 7% for the full year and also seeing unemployment falling more rapidly than expected while inflationary pressures heat up. By contrast, the Fed's summary of economic projections in December indicated a median estimate of just 4.2% for GDP, along with an unemployment rate projections of 5% and core inflation running around 1.8%. Those numbers are likely to see material upward revisions, according to Bank of America. The GDP figure could be raised by at least 1.5 percentage points to a range of 5.7 to 6%, while unemployment could be taken down to 4.8% and inflation raised to the Fed's 2% target, Bank of America estimated. Inflation already has become a headache for the Fed, with rising bond yields and market pricing rising by one measure to the highest level in nearly 13 years. So this explains why the market is where it is. It's the rising bond yields. Economic team in a note called this week's meeting one of the most critical events for the Feds in some time. Powell will have to strike the right balance between an optimistic economic outlook and the Fed's willingness to allow inflation to run hotter than usual in an effort to make sure that employment gains are broader and inclusive of income, race, and gender, Bank of America noted. Okay, and here is definitely something that we need to know. In recent weeks, markets had been speculating that the Fed would adjust its bond purchases to bring down long-term rates that have jumped to pre-pandemic levels this year and caused volatility in the stock market. Powell has pushed back on that notion. For us, we should rest assured that the inflation rate is not yet changed, so nothing to panic yet. I have already mentioned that one of the reasons why I chose all of these companies, and I chose to cover companies that are disruptive, because disruptive companies innovate themselves out of a pandemic, out of a market correction, out of a crisis. So for that reason, I feel that it's a lot safer for me to invest money into this sector. At least that is my thinking. I hope that you find the information helpful. Thank you very much.